following is a paid advertisement program provided by Premier Investments and Wealth Management. An airing of the program is not to be considered an endorsement or recommendation. The opinions expressed are those of the hosts, guests and callers and not necessarily of KFXR or iHeartMedia. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.
The views and opinions in this show are those of Premier Investments and Wealth Management, their guests alone, and do not reflect any other entities. The information in the following program should not be construed as an offer to sell and is not intended to replace the advice of a qualified tax advisor or legal counsel. The statements in this program do not reflect those of LPL Financial, Premier Investments and Wealth Management, or its affiliates. And welcome to the Premier Investments and Wealth Management program here on Talk Radio 1190, 1190talkradio.com. My name's Doug Wagner, along with the big kahuna, Roger Abel.
How you doing, Doug? Good to be back.
Got that in there this time. I was so excited I called myself Dog. So,
well, I kicked the camera, so we're off to a good start to this show today, Doug.
And action. Hey, before we get into the program here, I want you to go to premieriwm.com. From there, click on Get Started. And once you do that, you'll answer a few questions. You will be provided with a one-page My Financial Confidence document. Really what this is, it's a roadmap for you. I've seen these, and you actually can get a copy of a generic one if you want one by going to premieriwm.com and just hit the contact button and ask them for it. But what they do is they personalize this for you. Are you ready for retirement? Are you ready for your kids' college education and to pay for that? Or maybe even are you ready for that dream house, maybe a lake house or maybe a hunting lodge in North Texas up in the mountains? You can find out by going to premieriwm.com, click Get Started. We were talking at the very beginning about when you have markets moving, you have lots of turmoil in everything. You had, for example, European markets. The interest rate went down, but the United States Federal Reserve decided they weren't going to do that. There was a very short divergence in the markets there. Some people started looking at panic-driven investment during that time, during a crisis. How do you keep your clients focused on what is the long-term rather than doing what is short-term they think good, but ultimately is long-term negative?
That's a really good question. I think the first thing we try to do, and I think the goal of this show, Doug, and it's been the same for 15 years, is to really educate people on past history and events, show them why making a panic-driven decision would be a horrible idea. And I've got a little chart, so if you're watching this, you'll see it on YouTube. But we went back and took a look at the last 60 years. And we've identified 7 events that we would consider very stressful when we saw panic-driven selling. And we're really quantifying this by more than a 30% drop in the market. Okay. So let me just tell you what the events are. 1968 to 1970, we saw interest rates above 9%. We're not even close to that right now. But we saw panic-driven selling.
Vietnam War as well.
Yeah, 36%. Good point. Vietnam War, it was down 36% that period of time. From 73 to 74, we had Watergate. We had the Middle East oil embargo, down 40% top to bottom. Black Monday, Dow Jones Industrial dropped 22% in a day, market down 33.5%.
Okay.
Then we go to the dot-com bubble, down 37%.
Yeah, there was a long because they had accounting scandals. I know Enron was one of those.
That led into WorldCom.
9/11.
Enron, down 33.8% in 2002. 07 to 09, the great financial crisis, housing bubble, which is probably the most recent, really panic-driven outside of COVID. We were down 57%. And down 33.9% during COVID.
Yeah.
And what we've seen is that markets have been ultra resilient during this period of time. There's never so far been one of these events that the market did not recover from. In fact, most of the time, if we rewound the tape and you walked into me, Doug, and said, hey, how much money would you have invested the day before the housing crisis and the great financial crisis? How much money, knowing what you know today, would you have invested the day before? The answer would be all of it.
Right.
Because I know what the outcome is. One of the things that happens though during these periods of time, and you can be a testament to this because you are part of the media, what happens? We zone in on negative events in the media. This is mind-blowing to me. But during the pandemic, Fox News saw its ratings climb 89%. CNN's ratings were up 193%. MSNBC up 56%. So what it shows, and this is why people start to panic sell, because everything they're surrounded with is all bad news. There's no good news. There's nobody talking about, well, yeah, but maybe this is the time to start doing things. And part of the reason that we subscribe to that financial planning process, Doug, is to help people quantify the risk capacity. And once we do that, we're able to give people reasons why they own a portfolio and they have conviction to stay the course.
Exactly. And that's something that I had to go through because as a client, this is something that I wanted to make sure that I bounced off you because I didn't want to sit there and just bark orders. I needed to make sure that I was doing what was necessary as well. Let's talk about the risk of mistakes that you make during crisis times like this if you do make a knee-jerk judgment or snap judgment on something.
Well, I mean, it's human nature to be really fearful when you see something go down 30%. Right. I was doing a podcast, I believe it was yesterday actually, and I believe the chart was from the Hartford Group, and they had a chart and just showed the difference between two individuals that each invested $10,000 in 1984. Okay. Individual A stayed in the market, and any time there was an 8% monthly drop in the stock market, they put $2,000 more in. Individual B, every time the stock market went down 8% in a month, they took $2,000 out and put it in cash. At the end of the 40-year period of time, individual A had $1.2 million. The person who thought it was a good idea to move money around and do what we call a financial mistake, move it to cash, and with $260,000, it was $1 million difference.
Oh,
$1 million bucks to feel better. I mean, ironically, as you know about the stock market, and we've said this a million times, the stock market's the only parking lot that's empty when there's a 50% off sale.
Yeah.
You won't find a car in it. But if you go to the biggest supermarket, the biggest mall out there, if they said everything in the store is, everything in the building is 50% off, look at Black Friday. Look how busy it is. That's what it would be like if there was a 50% off sale. But the stock market, there's crickets.
And that's what you taught me with Premier Investments in Wealth Management is that for me, I like coupons. It's a coupon clipper. Really is what it is. It's time to go coupon clipping because you're getting these stocks in a basket of stocks at a huge discount.
Do you ever feel like your financial goals are just out of reach? It's time to take control of your future with Premier Investments in Wealth Management, your partner in financial independence. Imagine a financial plan that's as individual as you are. At Premier Investments in Wealth Management, our team of experienced advisors will work closely with you to create a roadmap tailored to your dreams, whether it's buying a home, retiring comfortably, or starting a business. We believe in transparency and education. We'll help simplify complex financial concepts, provide clear guidance, and empower you to make informed decisions. Financial wellness is within your grasp. Visit www.premieriwm.com to schedule a meeting with an experienced advisor today.
You're listening to the Premier Investment and Wealth Management Financial Program and Talk Radio 1190, 1190talkradio.com. I'm Doug Wagner along with Roger Abel, and we're talking about avoiding costly, panic-driven selling or movements during a market movement or market correction that's significant, really anything above 30% up to 57%, as you noted back here from 2007 to 2009, the housing bubble and the financial crisis. We're talking about maintaining perspectives in crises as we look through this, Roger Abel. And the whole thing is that if you have a financial plan and a wealth planner with you, you're not going through this alone.
Ironically, in times of chaos, we absolutely become the financial counselor. I actually, literally before the show, had an individual I was meeting with. She's been with us since 2015. We went back and looked, and she was talking about COVID, and she was telling herself, don't call, they've got this. Don't call, they've got this.
Yeah.
Don't call, they've got this. And she goes, but finally I called just to make sure things were okay. She wanted us to reinforce that she was doing the right thing. And she actually brought up as a point that part of the reason I didn't panic was because, number one, we've been seeing her on a very regular basis. But number two, we'd put together a financial plan. She knew why she had equity style investments, and she had a good idea of what the outcome was going to be, and it allowed her to stay the course. That said, she came in today expressing concern about where the markets were. She said, hey, I just think there's bad things out there. What should we do? I said, well, if we're concerned about what's in the future, stock market's basically all-time high. Now's the time to make changes. So we pulled up our financial plan. We looked through the scenarios. We figured out what we could do, how much risk she needed to have to be successful in the stock market. And we made changes. But she made changes at a good time currently versus when panic's already set in. And if you think about it, there's a lot of charts and studies out there, but I think the one that stands out that most people should recognize is this Dalbar study. And I don't know if you've heard of Dalbar, but we've talked about it. It just shows the difference between what individual investors do in the stock market. And it's really about 2% per year less over the last 30 years. The average equity investors averaged 8.
If they're going off their ideas and what they're doing.
They're trying to time the market.
Right. Okay, market timers.
And it doesn't, the individual before, she goes, well, what if we just moved it to a really safe spot for 2 years and then moved it back when things got better? Well, I said, they're not bad. I said, we don't know that they're going to get bad. They could. So that's market timing. But she didn't look at that as market timing.
Right.
We came up with some different unique ways to add some protection to her portfolio and do some unique stuff to make her feel better about her position. But this just shows that market timing doesn't work. Time in the market works for people. But if you start to equate underperformance of 2% a year over 30 years, it's massive.
Oh, it's huge.
It's massive.
Yeah.
And most of that's all driven by individuals trying to time the market.
Right.
You know, I think back to like 20 years ago, internet was new. Most people didn't have online access.
Yeah.
They had to wait for their statement to come to know what was really happening with their account. And I don't know the statistics on it, but I'm going to venture to guess there were significantly less changes being made in 401k plans 20 and 25 years ago than there are today. And the ability to check it every day will drive you absolutely bananas. And I'm guilty. I look them on every day. First thing I do.
Remember, it's Sundays. I used to wait for the newspaper because they'd have the mutual funds index in there, and I'd sit there and look for the different mutual funds in there. Now, I mean, but here's the thing. You've got me to understand this at Premier Investments and Wealth Management, Roger, the idea that, you know what, my biggest investment right now is my home. I'm not checking its value every day. I mean, I don't need to check my 401k value every day because it's part of my financial plan. And I know that I'm putting money in whether the market's at an all-time high like it's reached lately, or if the market's down 30% where it's bargain basement prices, I'm going to be putting money in. I actually may work with you to find more money to put into the market when it's at a low because that's where I'm coupon clipping, right?
Well, the chart I looked at the other day actually made me not rethink my investment strategy because I'm dollar cost averaging. I'm just investing all the time. It's the same time every month. It's just a process. But when I saw what happened in that chart when people invested when the market was down 8%, I'm like, why wouldn't I, instead of trying to time a bottom, like you just said, when the market goes down, maybe I'll, instead of trying to time it, just say, oh, wait, it went down 8% this month. This is the automatic trigger, or it goes down 6%. If somebody has a process that it's not about timing. It's, hey, this is what I do when this bad thing happens. And really what you're doing, like I tell my kids, you're turning lemons into lemonade.
Yeah.
That's all you're doing. And I think that for me, I'm going to actually take that away. After I did this study, I'm like, I'm going to do that. I'm going to have a set amount that when the market goes down X% a month, I'm going to invest.
Yeah.
Because, you know, as an advisor, people think we're different. We have all the same emotions.
Yeah.
They're identical. We just are armed with a little bit more firepower because we deal with this every day.
Yeah.
But our accounts go down. So we don't have magic.
Like everybody else's.
They go down the same route. So someone else's account's down 30%, mine's down 30. I don't feel good.
Yeah, right.
But we figure out a way to work around the problem and turn it into a positive.
And see, here's the thing. By the way, you're listening to the Premier Investments and Wealth Management program here on Talk Radio 1190, 1190talkradio.com. Doug Wagner along with Roger Abel from Premier Investments and Wealth Management. Here's what makes this significantly different. You know, maybe you've gone to a casino, maybe you go to Vegas or something like that, and you're sitting there and you're going, you know what? The market went down. And you're saying, well, I lost 30% of my stake. I need to start going after that stake by increasing the amount that I bet. Here's the problem. In Vegas, the house always wins, okay? If you look at historically, over the decades, the amount of money that you put into equities, when you put it in for the long-term strategy, that money is made back. Now, you can't guarantee it, but the whole thing is, name me a decade when there hasn't been a positive return from the big indices like the S&P 500.
I think we've had one.
Yeah.
I think we've had one negative 10-year period of time.
Right.
And it was slightly negative.
Exactly.
And yeah, you could go focus on all the bad stuff, or you can focus on all the good things. I think we shared the chart last time.
Yeah.
On this show, the apocalypse du jour, the 30 reasons not to invest. And here's what's ironic. And I hear this all the time. It's different this time.
Yeah.
You're right. It is different because it's not known. Just think if we had another COVID, like, oh, COVID happened again.
Yeah.
Oh, well, guess what? We know the outcome, so panic won't set in. Panic sets in because of the unknown. So yeah, it's a different event, but likely over the time, it will be the same outcome. I hear it every single time. Guaranteed. Great financial crisis. It's different this time.
Yeah.
COVID, it was definitely different this time.
Yeah.
.com bubble, yep, it was different. But what's been the same net result? It goes up.
Yeah.
Elias, I think, which Elias is one of the gentlemen we work with, and you know, our team down in Dallas, Chris McNeil's down with us in Dallas, and we talk about this, but Elias came to me and he said, Roger, the only way the stock market's the only way you wouldn't be investing in the stock market is because you think American companies are going to get worse at making money over the next 10 years. Think about that.
Yeah.
I know a lot of people believe that the stock market is this fictitious number and it's made up. No, it's a number that's based off of the earnings of the individual companies. It's not just pulled out of the sky.
Right.
So the only way that the stock market doesn't prosper long term is if American companies get worse at making money. And guess what we know is not true? They don't get worse. They get better. They innovate. They change. They become more productive. Just every time there's a crisis, everybody gets better. Think of COVID. Think of what COVID has done to all of these companies. It made them stronger, better, more nimble. They figured out how to do it digitally. I mean, it's changed our business.
Right.
It used to be we worked in a local market. Well, now we have clients in 40 plus states.
Yeah.
Are you ready to take control of your financial future? The financial professionals at Premier Investments and Wealth Management are the guides you've been looking for. Picture this, a financial plan tailored exclusively to you. Our team of experienced professionals will work closely with you to understand your aspirations and develop a personalized roadmap to get you there. Whether you're dreaming of retirement, buying a new home, or sending your kids to college, we've got the tools to give you confidence in your financial life. We'll help you navigate saving and investing, retirement income, and tax strategies. Our job is not just about making money, it's about helping our clients make smart choices. We'll provide you with the tools and knowledge to confidently steer your financial ship toward a brighter future. Are you ready to embark on your financial journey with confidence? Visit www.premieriwm.com to get started. Your financial future awaits.
It's remarkable because when you think about what technology has done, it's allowed you to have better reach to more people, but at the same time, continue to have that intimacy that a financial advisor can offer, because really that's what it comes down to. If you're on your own and you're getting tossed by the tides of a market that's roiling and boiling and rumbling, you can fall overboard. But if you have a financial advisor that can offer some things to you, then it really can help. What are some of the things that a financial advisor and a wealth advisor makes a difference with?
Honestly, I think the number one thing people need to recognize what wealth advisors and financial advisors do. We don't outperform the market. That's not the goal.
Right.
The number one thing we do is really what you brought up earlier. It's emotional support and guidance. We figure out how to help people work within the framework that they need to be successful.
Okay.
So this is what you need to do to be successful in retirement. These are the emotional things we know are going to happen. How do we conquer those things? The second thing is you have a plan. Like, you can't get conviction in anything without a plan. You think Bill Belichick had conviction winning a Super Bowl without a plan?
Yeah.
No.
Yeah. You're right about that.
And it doesn't mean that the plan's static. It's going to have to change. You get down 3 touchdowns, what do?
You got to change
You
up.
You have to have a very dynamic plan, which is exactly what we need to have. Those are the strategic adjustments we make.
Yeah.
Just like the individual that was in here earlier. Hey, I'm really concerned. What can we do? Well, let's pull your plan up. Then
It's their plan, by the way. It's theirs. This is not just
my
a
plan.
generic plan.
No, it's
Yeah.
specific to her. I said, okay, this is where we are. This is what we need to do to be successful long term. We can do this, scenario 1, 2, and 3. Which would you like to do? And then we implement the plan. And Doug, part of that revolves around education.
Yeah.
I've said this for a long time. If I ask somebody what their risk tolerance is, and they don't have much knowledge about investing, the answer is going to be, I'm really conservative.
Yeah.
And it's conservative because anytime we're in an unknown situation as human beings, we automatically shut down and opt for the safest option.
Right.
Because we don't know. The more you start to understand and learn about the markets, interestingly, your risk tolerance goes up. And I know this because I have individuals who are 60 plus years old that they only want to be 100% stock because they understand that's their opportunity to
Make money.
make the most money.
Yeah.
Those individuals, when I run that financial plan, there's cases where their optimal outcome is not a 100% stock portfolio. And I have to talk to them about why we have to do this.
Right.
Like, I'm trying to dial them back. But they understand that over time, the markets likely will outperform other asset classes.
And that's one of the things that I like about the individual financial plan that you drop is that it really takes into account everybody's proclivities. I mean, what you said about the individual, if they don't have a lot of education or they don't have a lot of information, which you then provide, they can actually move from where they had been to where they need to be in the future. But here's the whole thing. You're not going to shove them anywhere that they don't want to be. That's where the education and information comes in because, hey, I'm glad that you told me that this is a coupon clipping market. So when the market's down 20%, maybe I'm going to put 20% more money into it so I can buy at a bargain basement price.
One thing I want to clarify about education. I'm not referring to general education. I'm referring to financial education.
Right.
Because,
Yeah,
listen,
it's not civics.
I have a client who's a brain surgeon, legit brain surgeon. When it comes to financial education, he has nothing to do with this.
Right.
I'll give a good example. My best friend's a foot surgeon. His wife's a gynecologist. I go ask him about anything medical, and they're like, unless it involves below the ankle, I have no idea because he's a foot surgeon. He goes, if it's above the ankle,
Either
I
one of
don't
them,
know.
really, so yeah.
Yeah. I mean,
Yeah.
They're like, we don't know. When it comes to money, they don't know more. We don't teach this. So, just the more educated people are about this, the better decisions that they actually make. The other thing it leads to, it allows them to set better goals.
Yeah.
I mean, most of all financial planning revolves around a goal. If you don't know what the goal is, it's really hard to do this. And I have a great example. I'm working with an individual. They're retiring from a medical facility, and they have no kids, no beneficiaries, highly successful, have accumulated a big pile of money. They're going to retire at 60 years old. And we're trying to figure out how to spend down their estate, whether we're gifting it away because they have nobody to leave it to. Well, they want me to back into all these numbers of what they could do. I go, guys, how about you just tell me what your goals are? Mm-hmm. And then let's figure out how to make it work. And as soon as I change that conversation, boom. They're like, I want to do this. Yeah. Everything became clear versus me saying, well, you could spend this amount on this. Mm-hmm. I just said, what are your goals? You have to have a clear goal of what you're trying to accomplish.
Right. The end point is the idea or what you want to accomplish rather than the dollar amount. And that's one of the big things is because the dollar amount could be meaningless completely, but it depends on what the goal is.
Yeah,
right?
Tell me what the goal is, and I'll tell you whether you can do it or not.
Okay.
We'll model it. Because what do? We set up multiple scenarios.
Exactly.
I mean, we do. This is the coolest thing about it. Mm. I had an individual the other day. It was so cool. So we break it down into 3 areas. Needs, which is, hey, this is what I need to live on.
Right.
Wants, which are the things I want to get next. Mm-hmm. And then wishes. Well, these people are knocking it out of the park. I mean, their probability of success is really high.
Yeah.
I go, do you want more lifestyle? Do you want more things? Do you want more experiences? What do you want? Mm-hmm. And we were able to figure out how to maximize each of these scenarios so that they don't underspend. Yeah. Their goal is not to leave an inheritance to their kids. Their goal is to live life now. So we built them a plan. Hey, how do we take more vacations, but still make sure that long term our basic living expenses are met?
Final thing is making sure that you're building resilience within these people and within their financial plan so that as you make that transition, toward retirement, then in retirement, as you work toward whatever the goal is, whatever that end-of-life goal is, make sure that it's a resilient program as well so that they can take on the storms of life.
Well, it leads into kind of that next phase that we do for people, Doug. It's how do we develop a bucket strategy to take away the human emotion? It's exactly what I do with the individual today. She's like, this is awesome. Can you give me a copy of this? Because now she knows the money that's for growth is 6+ years. Mm-hmm. We don't need to worry about everything else is cash alternatives, fixed income, stuff that shouldn't be that volatile. And I think everybody should take this away. The reason you put together a financial plan, it's simple. More financial confidence and a better sense of financial direction. That's why. You want to know where you're going, and if you're on track, if you're not on track, what do you need to do to get there?
That's Roger Abel from Premier Investments and Wealth Management. And really, this is just that simple. At premieriwm.com, click Get Started, answer the questions. They will provide for you a 1-page My Financial Confidence document that you'll be able to use as the first step on your journey. You know what? You have a meeting with them, they'll let you keep the document. But you know what? I think if you're like me, you're going to want to take that next step with Premier Investments and Wealth Management toward a financial future that includes a plan for you and resilience so that you don't have to worry about the markets and you can sleep better at night. That's really what it ultimately comes down to. PremierIWM.com or get in touch with them at 800-383-6590. For Roger Abel, I'm Doug Wagner. Thanks for hanging out with us here on Talk Radio 1190 and at 1190talkradio.com. Next week, everybody.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of